In this recording, we're going to continue on with focusing on what is cost for inventory. So again, as a review, the cost principle from the conceptual framework tells us to include all costs to acquire the merchandise and get it ready for sale. So here are typical costs: the invoice price less the purchase discount. However, we're going to look at here in just a little bit where we may or may not want to focus on the purchase discount as a reduction of our cost. There's two different theories to that, so we'll look at that in a little bit. Shipping, and this goes over the shipping terms, depends on where the legal title transfers. If title transfers at shipping point, then the shipping costs are the buyers. If shipping costs, title transfers at destination, then the shipping costs pertain to the seller. In-transit insurance, assembly costs, all of those are part of the cost of ending inventory, and then of course ultimately cost of goods sold. It would not include interest if we have to borrow money to finance purchasing our inventory, or freight out costs, because those are costs, that's the freight we pay. If we're the seller and we deliver the goods, that's just a selling expense. So let's look at purchase discounts, because as I indicated earlier, there are a couple of ways of thinking about that. So here's a little example. We have $100 we paid $100 for goods, and we have a 5/10 N/30. That means there's a 5% discount if paid within 10 days. Otherwise, the net amount is due within 10 days. So if they pay, in day 15, that means we're going to pay a full $100 and we didn't take advantage of the discount. But there are a couple of ways of thinking about that. Some accountants think that really the cost of the goods is $95, and then the other $5 costs are the fee for paying late, somewhat akin to like an interest cost or some sort of finance charge. So there are two methods then for accounting for discounts. One is the method you're really already familiar with, and we went over that in the first recording, where here's a little example. We buy $10,000 worth of goods. We put it in the purchases, assuming this is demonstrating the periodic system. But nevertheless, the full $10,000 goes in as cost of the goods. They're going to pay for 4,000 of those. Again, 4,000 at 2%. There's a 2% discount there for $80. And so cash goes out of $39.20, but we need to remove the full $4,000 out of accounts payable, or we're going to end up with still having a balance in accounts payable. And then finally, the remaining $6,000 is paid in full. So we can see, they put $10,000 in accounts payable, and then they remove 4 and 6, and they end up with a zero balance. But what if we want to account for that discount, or the unpaid discount, or the not taken advantage of discount, as a finance charge? Well, in that case, we use the net method. In the net method, we're only going to increase purchases at net. So again, $10,000 at 98%, right, net of the 2% discount is this $9,800. So $9,800 is going to go in as cost. When we pay early, then, $4,000 again at 98% will give us this $39.20, and that's going to go out of accounts payable, and that's what we pay. But the $6,000 did not get paid within the discount period. So that 2% unused discount, or $120, is really sort of like this interest cost. So we're going to record that separately. Purchase discounts lost. So that's going to go in this account. Now, where do we actually report that on the income statement? Well, if it is an interest cost, it's not going to be a part of cost of goods sold. So let's look at our next page. So I've gone ahead and I've posted all of those. The accounts payable and the cash, you've seen that in the prior illustrations. What I wanted to focus on really is where cost goes. So under the periodic method, sorry here, trying to line this out, purchases less the discount, would be 9,920. Ultimately, when the goods are sold, that becomes part of cost of goods sold. So the purchases is our original cost. We got a discount of 80. Our net cost is 9,920. So if we assume the goods were sold for $15,000, we have our revenue, less cost of goods sold to get our gross profit, and then net income. Over on this method, though, we don't have a purchase discount, and we're going to record cost of goods sold at $9,800. This purchase discount lost is going to go down with other expenses of $120. So it's going to be considered a financing cost in the other category on the income statement. So just to point that out. Okay, and then one last thing on this. What if the discount has expired, but we haven't paid the account yet? Because over here, we didn't record the discount lost until the cash was paid. But what if it's the end of the period and we've lost the discount, but we're not paying cash yet? In that case, instead of cash as our credit, the credit will go to accounts payable. And I mention that because you're going to see that in one of your homework problems. So now let's move on to problem 6 in your homework. I have scheduled that out a little different than the sequence in the actual problem. I've listed out all the periodic FIFO, LIFO, and weighted average. So let's kind of go through it that way. And I am going to demonstrate this a little bit different probably than the textbook, because I like students to be able to solve for both cost of goods sold and ending inventory. So in periodic, we solve for goods available for sale. We take the beginning inventory. There were 2 purchases, so we solve for goods available for sale both in quantity and, of course, dollar amount. So once we know goods available for sale, then we assign those costs to the goods. If it's FIFO, in the narrative, we know there's 4,700 units that were sold. If it's first in, first out, then we assume this first one in is the first one sold. Second one in is the second one sold. Third one in, part of that gets sold. There were 3,000 we had assumed were sold. We need 4,700, so we plug the 1,700 in to make it balance. And then of the 3,000, if 1,700 is sold, that leaves 1,300. So just a FIFO method. Most of you probably still remember this from your earlier course in accounting. So then we schedule out both cost of goods sold and ending inventory. I like for students to do both. So then you can add your total cost of goods sold, your total cost for ending inventory, get your 117,000, and then you can check that with your goods available for sale dollar amount. Under LIFO periodic, again, it's always the same starting place. Solve for goods available for sale. We know 4,700 were sold. And then the assumption is that we first sell, the last purchase is the first one out, and then the next one. So only part of it will be sold, the total 4,700, and then remaining 300 are on hand, and then beginning inventory is still on hand. Now, just because we cost it this way doesn't mean that this is the actual flow of goods. This is just a cost assumption, a cost flow assumption. So nobody really in their right mind actually sells in a LIFO basis, but we allow for the accounting cost flow to be on a LIFO basis. Okay, and then weighted average. Again, same starting point, get your goods available for sale, and then you're just taking this dollar amount, divide by the 6,000 units to get $19.50 each. By the way, do not add up $12, 18, and 23 and divide it by 2. That's merely an average. We are solving for a weighted average. So weighted average is going to take total goods available for sale divided by quantity of goods for sale. So in this case, the second purchase, because there's more of them, that $23 will be weighted more heavily than the 12 in beginning inventory. So it's a weighted average. And then it's just real easy. We know our quantity, take this times our average to get our goods available for sale, and likewise for the ending inventory. Okay, now that we have that, let's look at, well, what difference does it make? Well, let's assume it tells us that of the, here we have our 4,700 units were sold, and it told us the sales price for each. So whether we use FIFO, LIFO, or weighted average, this will be our sales revenue. Cost of goods sold, I plugged those in from what we saw for earlier. Here's our 87.1, our 99,600, and our 91,650. So I'm just plugging those in if we had used this method, that method, or that method. And then, you just do your arithmetic to solve for gross profit. Then I plugged, we assume operating expenses, I just said, what if they're $15,000? So it wouldn't matter which inventory method we use, operating expenses would be the same. Then I solve for operating income by arithmetic. Now let's assume that income tax expense is 15%. Well, that's going to be this 45,500 times 15% to get the 6825. It'll be the 33,000 times 15% to get the 4950, and 40,950 times 15% to get that. And then we'll get different net income numbers. So if we were just comparing FIFO, LIFO, and weighted average in a period of inflation, and again, in this particular homework problem, prices are going up, so we're looking at in a period of inflation, we would actually, kind of like FIFO. By the way, this is all cosmetic, isn't it? It's artificial profits. The differences here are cosmetic because we know we bought the same units at the same cost. How we cost it then is somewhat cosmetic. The differences are cosmetic. So in periods of inflation, FIFO is going to give the appearance of larger profits. When we go down to the balance sheet, well, ending inventory goes on the balance sheet. And here's where I plugged in the dollar amounts that we saw for ending inventory on the prior page. So we can see those amounts. And then if we assume also retained earnings will differ because net income's going to flow into retained earnings. I'm just pretending if this was the first year and we had 0 retained earnings to begin with, then net income becomes our ending retained earnings. Here again, if I compare FIFO, LIFO, and weighted average, I like the bigger one. So in periods of inflation, FIFO gives the appearance of larger profits and a larger balance sheet, larger assets, larger equity. Now let's go to a statement of cash flows. On the statement of cash flows, well, we're really going to convert sales revenue to cash receipts. Well, that won't matter whichever method I'm using because I'll have sales revenue. And even cost of goods sold converted to cash paid for inventory isn't going to differ because, again, we paid the same amount for the goods. That doesn't differ on how I costed it for goods sold in ending inventory. Operating expenses, it's going to be the same amount paid for those items when I get down to cash flow. The expense that's going to differ, though, is this income tax expense. So when we get down to cash flow, do I want to pay $68.25, $49.50, or $61.43? Well, here, I don't want to pay as much. So LIFO comes into play here. And really, this is why the companies that use LIFO, although there is some theory to using LIFO that's in your textbook, and you will want to understand that, but when it comes to reality, a lot of companies in the United States use LIFO because it has income tax advantages, and we can see that here. Okay, so that's LIFO, FIFO, and weighted average. This problem also asks you to do it using Perpetual. I've gone through the calculations here. The difference in Perpetual is it's the same process, you just have to do it every time there is a sale. So I'll just go through FIFO and then I'll let you just look at the rest on your own. But for FIFO, we had beginning inventory in the first purchase and then there was a sale. So we had goods available for sale at that time for these amounts. Then we were told 2,500 units were sold. So then we go back and under FIFO, first in, first out, and then we need another 1,500. So the 2,000, 1,500 are sold, 500 are left. And then what's the balance? This ending inventory is the remaining balance. this new balance will go forward to the inventory account. So 500 at 9,000, and then there was this second purchase, and then we arrive at goods available for sale, and there was another sale. 2,200 units are sold. So then we do FIFO, first in, first out, and then of the 3,000, 1,700 are sold, and we have the 1,300 left in ending inventory. The other thing that I did is that I added up cost of goods sold. So that's going to be the 39,000 and the 48,100. Add those up and you'll get total cost of goods sold for that accounting period. Okay? And then you can look just with the perpetual LIFO and then the perpetual moving average. The last thing I want to look at is just some big picture stuff of FIFO and LIFO. And again, during periods of inflation. So I just kind of drew a chart here, time's going by and prices are going up. So if I buy goods in September, it's going to cost me more than what the goods did in January. So let's go back and look at, well, what difference does it make? Well, under FIFO, first in, first out. So cost of goods sold, it will be these earlier costs, right, down here. So cost of goods sold will be lower under FIFO. But ending inventory, right, we might assume these are the goods sold and these are the goods that didn't get sold. So ending inventory is going to be higher under FIFO. Now let's go across the income statement, cash flows, and balance sheet. Okay, so if we have a smaller cost of goods sold, that's an expense. How does that affect profits, like gross profit, operating income, income before taxes, and net income? Well, a smaller expense leads to larger or higher profits. If we have larger income or larger profits, we will pay more tax on that. So higher profits lead to higher taxes. If I pay more for taxes, I will have a smaller amount in the bank. So my cash in the bank will be smaller. Okay, so that's going through FIFO. Now LIFO is the other way. Last in, again, the cost flow assumes these last in are the first ones sold. So we will have a higher cost of goods sold. But down here, so if the last in, first out, these are sold, then these down here did not get sold. So ending inventory will be smaller. Okay, now let's go through the middle stuff. If we have a higher expense, then our profits will be smaller. Okay, larger expenses lead to smaller profits. Smaller profits lead to smaller taxes paid. If I pay less to the IRS, I'm going to have a larger amount of cash in the bank. So just going through all of that. Okay?